Top three things in my notebook this morning. Number one, the 10-year bond yield in the U.S. Number two, the financials, as in the stocks. And number three, the price of oil. So first on the 10-year bond yield, it went right up to our trend line. It failed there and basically recoiled lower this yesterday. So bonds acted quite well, and that's really what we would expect to see bonds to continue to do as we go into the quarterly GDP report on Friday. So we do think that there will be a two-handle in front of GDP, and yes, we think that GDP will slow, yet still in the coming quarters from there. So again, if indeed growth slows, 10-year bond yields seem to be tracking, I shouldn't say seem to be, continue to track the slope of U.S. GDP growth, which is obviously from a second derivative perspective going negative now. Now, the second point would be on the financials. That's the last sector that you want to own in the face of what I just said. So again, falling bond yields create what we call yield compression. So the 10s minus 2 spread in the 10-year minus the 2-year yield starts to compress. That's bad for net interest margin. That's bad for the financials. So again, the financials are also trading with bond yields now, which we would not consider a good thing. Bond yields were down yesterday. Financials were down yesterday. That's the way that it should be. And then finally, oil. I mean, if you want to get long something, first of all, buy oil. Secondly, buy companies that are levered to the oil price. So again, there's plenty of things to do in energy. I think energy has been the best acting sector for the week to date in the S&P 500. So again, that makes sense because, again, you want to be buying inflation accelerating. It fits really like a glove from a quadrant perspective in our 4-quadrant investing model, which is, of course, during stagflation, you want to own deflation, which comes in the form of commodity prices and energy specifically. So those are your top three things.